They passed it. A new banking rule goes live tonight. Pay attention. At 5 p.m., doors closed, systems flipped, and a policy quietly took effect that changes access to money. By Monday morning, what you call your account operates on their timetable, not yours. Friday was chosen deliberately, when markets sleep and headlines thin, so the change settles before questions begin. A $500 daily cash cap. A 7-day wait to request larger withdrawals. Try moving funds into gold, crypto, or silver, and the transaction pings a risk engine. Accounts flagged. Access paused for 30 days. This isn't rumor. It's enacted policy. Greece, Cyprus, Lebanon. The sequence was identical there, and now the pattern has arrived here. The real question isn't whether this touches you, it's whether you still have 48 hours to prepare. Welcome to Wealth Casebook. Before we break down what just happened to your bank account, do one thing for yourself. See the subscribe button. Everyone mentions it, but here's why it matters. If you've lived through a few cycles, if you remember when liquidity meant cash on demand and contracts meant trust, you already know these changes don't debut on the evening news. They appear in dense filings, buried in footnotes, released after close on a Friday. This channel reads that fine print, so you don't have to. Subscribe not for me, but for clarity, because what we're about to cover could separate readiness from regret. And drop a comment telling us where you're watching from. The United States, seeing this unfold in real time. Europe, where similar limits are becoming normal. Or somewhere else, watching the dominoes tilt toward your border. This isn't a local adjustment anymore. It's a coordinated shift, and it's global. Stay focused tonight, review your options calmly, and listen closely, because timing matters. Access changes quietly, and preparation favors those who act before rules harden and windows close for ordinary depositors everywhere. Now, let us examine what actually changed inside the banking system and why the timing matters more than the announcement itself. At exactly 5 p.m. on a Friday, the familiar rhythm of the financial world slowed to a stop. Branches shut their doors, customer service lines went quiet, and the system entered its weekly pause. But this time, something fundamental shifted beneath the surface. While most people turned their attention to dinner plans and weekend errands, a regulatory switch was flipped. A new rule took effect, written in language so technical and deliberately dull that almost no one noticed it happening. The name sounded harmless, even responsible. Liquidity, stabilization, market resilience, systemic continuity. Words designed to signal safety rather than alarm. Yet, behind that phrasing was a clear operational change. Access to deposited money would no longer be immediate or unconditional. Regulators didn't need a press conference. They didn't need debate. By activating the rule after markets closed, they ensured the outcome was settled before the public had time to react. By Monday morning, the change would simply be reality. The first visible effect appeared at the ATM. Withdrawal attempts above a modest threshold began to fail. Not because accounts lacked funds, but because new limits were now embedded into the system. A ceiling had been installed. Walk into a branch and request a larger amount, and the answer would no longer be yes or no. It would be paperwork, approval, a waiting period measured in days. Money that legally belonged to the depositor was still there, but temporarily unreachable. Tation offered was calm and reassuring. Officials spoke of preventing panic, discouraging bank runs, and maintaining confidence. But those explanations only make sense if there is something to panic about. Banks do not restrict access during periods of excess stability. They do it when internal math begins to strain. The modern banking system is not built on stored cash. It operates on a fractional reserve model, meaning only a small portion of deposited funds actually exists as liquid money. The rest is lent, leveraged, and invested across layers of financial instruments. Under normal conditions, this works. Most people don't withdraw large amounts at the same time. Confidence keeps the system intact. But when confidence weakens, even slightly, the structure becomes fragile. Requests increase, liquidity tightens, and the system's margin for error shrinks fast. What regulators see long before the public does are balance sheets under pressure, assets losing value, and obligations that no longer align neatly with reserves. That pressure doesn't announce itself with headlines. It shows up quietly in stress tests, in overnight lending markets, in internal risk memos. When the indicators turn unfavorable, the response is rarely transparency. It is control. Rules change. Access narrows. The objective is simple: slow the outflow before it becomes unmanageable. This pattern is not new. It has appeared repeatedly across history, across economies that were once described as stable, advanced, and secure. Restrictions do not arrive fully formed. They begin incrementally. A limit today, a delay tomorrow, a justification framed as temporary. Each step is small enough to appear reasonable on its own, but together they form a barrier. Economists who study systemic crises describe this stage as the denial phase. Public messaging remains optimistic while emergency measures quietly roll out behind the scenes. Officials insist the system is sound even as they reinforce it against stress. The contradiction persists only briefly because once restrictions are in place, they no longer require explanation. They become policy. What makes the current shift more significant is that it extends beyond cash limits. Embedded within the new framework is a broader definition of what constitutes suspicious behavior. Previously, that category focused on criminal activity, laundering, sanctions violations, fraud. Now it expands to include intent. Moving funds into assets outside the traditional banking ecosystem triggers attention. Purchases of cryptocurrency, transfers toward precious metals. Any action that suggests a desire to exit the system initiates scrutiny. That scrutiny is automated. Algorithms flag first. Reviews come later. Accounts can be frozen during the process, sometimes for weeks. Bills do not pause during that time. Rent remains due. Businesses continue operating. Access to money, however, does not. This mechanism does not exist to stop crime. It exists to discourage movement. The effect is subtle but powerful. It introduces friction at the exits, not by banning alternatives outright, but by making them inconvenient, risky, and uncertain. Most people will hesitate if they know a transaction could result in temporary loss of access to their funds. That hesitation is the point. And this shift did not occur in isolation. Similar measures appeared elsewhere within days, using comparable language and timing. When multiple financial systems implement the same controls simultaneously, it suggests coordination rather than coincidence. It suggests preparation. The question then is not whether these measures are justified in theory. The question is what conditions require them now, because systems do not preemptively restrict access unless they anticipate pressure. And pressure, once it begins, rarely reverses without consequence. To understand why pressure is building now, you have to look beyond headlines and into how modern banking actually survives stress. Banks do not fail suddenly. They weaken gradually, then all at once. The warning signs appear months earlier, buried in reports most people never read. Rising unrealized losses on long-term bonds. Commercial real estate loans quietly marked down. Corporate defaults inching higher, while official statements still describe the economy as resilient. These are not abstract metrics. They are signals that the system's cushion is thinning. When interest rates rise rapidly, as they have in recent cycles, the value of older assets collapses. Bonds issued at low rates lose market value. Loans made under optimistic assumptions turn fragile. On paper, institutions may remain solvent. In reality, liquidity becomes the constraint. They have assets, but not cash. and cash is what depositors demand when fear replaces trust. Regulators understand this dynamic intimately. Their primary concern is not profitability or fairness, it is containment. If too many people try to access funds at once, the illusion of stability evaporates. That is why the response is never to reassure with transparency, but to limit behavior preemptively. Access controls buy time. Time allows institutions to rebalance, merge, receive emergency funding, or quietly offload risk onto central banks. This is where the language of temporary measures becomes important. History shows that temporary restrictions have a habit of becoming permanent features. Once a system normalizes delayed access, it rewires expectations. People adjust. Businesses adapt their cash flow assumptions. The extraordinary becomes ordinary, and what was once unthinkable becomes policy precedent. Look at Greece. At the onset, officials promised controls would last weeks. They remained for years. A press followed the same script, introducing withdrawal caps and transfer restrictions overnight. Lebanon's banking collapse froze depositors out entirely, while balances still existed on screens. In every case, the pattern was identical. Reassurances first, restrictions second, normalization third. What differentiates the current moment is scale and infrastructure. Earlier crises were regional. This one unfolds in a world of integrated systems and instantaneous enforcement. Digital banking allows limits to be applied universally without physical barriers. Algorithms do not negotiate, they execute. Once rules are coded, discretion disappears. This also explains the growing emphasis on digital identity and transaction monitoring. Control is far easier when every action is traceable and reversible. Cash resists this logic, which is why it becomes inconvenient. Fees increase, availability decreases. ATMs vanish quietly. None of this is accidental. It's in alignment. From a systemic perspective, discouraging exits is rational. Depositors cannot easily convert balances into alternatives. Funds remain within the system. This stability protects institutions at the expense of individual autonomy. The trade-off is rarely stated openly, but it is implicit in every policy choice. Supporters argue these measures prevent chaos. Critics argue they redefine ownership. When access depends on permission, possession becomes conditional. You may legally own your balance, but functionally, you lose access to it. That distinction matters only during stress, precisely when it becomes visible. Another overlooked element is the impact on small businesses. Unlike large corporations, they lack diversified accounts, treasury teams, or political leverage. Cash flow interruptions can be fatal. Delayed access means missed payroll, unpaid suppliers, broken contracts, yet the rules apply uniformly without regard to scale. Stability for the system often translates into fragility for the periphery. This creates a quiet hierarchy. Large entities receive liquidity lines, exemptions, or backstops. Individuals and small firms receive restrictions and explanations. Over time, this reshapes the economic landscape. Consolidation accelerates. Dependence deepens. Choice narrows. None of this requires malicious intent. Systems evolve toward efficiency and control because those traits reduce volatility. But volatility for institutions often means hardship for people. The divergence grows slowly, then becomes structural. What should concern observers is not one specific rule, but the direction of travel. Each adjustment nudges behavior toward compliance and passivity. The range of acceptable actions shrinks. Preparation becomes framed as suspicion. Independence becomes risk. And once that framing takes hold, reversing it is nearly impossible. Controls justify themselves by their own existence. If restrictions are in place, there must have been a reason. If there was a reason, caution is warranted. The logic feeds itself. That is why moments like this matter, not because collapse is guaranteed, but because precedent is being set. Systems Remember the tools they deploy. They reach for them again when pressure returns, okay? In cyclical economies, always returns. Another layer often missed in these discussions is how quickly public perception adapts once restrictions are framed as protection. Messaging shifts from access to safety, from ownership to responsibility. The narrative becomes collective rather than individual. Sacrifice is presented as necessary, compliance as civic duty. Over time, questioning controls starts to sound unreasonable, even selfish. That psychological pivot is as important as the policy itself. Central banks play a critical role here. When liquidity stress intensifies, they step in as lenders of last resort. Emergency facilities expand, balance sheets grow. Losses that would otherwise force reckoning are absorbed upward, socialized across the currency. This process stabilizes institutions, but dilutes purchasing power. Inflation is not an accident of mismanagement, okay? It is a pressure valve, okay? It allows debts to be honored in nominal terms, while real value erodes quietly. For the average depositor, this creates a double bind. Access is restricted on one side, while value weakens on the other. You may not be able to move money freely, and even if you could, it buys less than before. Official explanations rarely connect these dots. Inflation is blamed on supply chains, geopolitics, consumer demand. Each factor plays a role, but monetary expansion is the constant beneath them all. As these dynamics intensify, policymakers search for tools that promise precision. Broad measures are messy. They affect everyone and invite backlash. Targeted mechanisms are preferable. This is where programmable money enters the conversation. Not as an overnight replacement, but as an incremental upgrade. Faster payments, better compliance, enhanced security. Each benefit sounds reasonable in isolation. But programmability also introduces conditionality. Funds can be restricted by category, time, or purpose. Stimulus usable only for certain purchases. Benefits that expire. Accounts that function normally until a threshold is crossed. None of this requires overt authoritarianism. It requires only policy goals encoded into software. Critically, these systems are introduced during moments of stress, when resistance is low and urgency is high. Once deployed, they do not retreat. They integrate. They become infrastructure. An infrastructure, once built, seeks justification through use. This trajectory explains why cash alternatives are increasingly portrayed as problematic. Physical cash enables anonymity and autonomy. It resists negative interest rates. It allows exit without permission. From a control standpoint, it is inefficient, so it is marginalized gradually. It's not banned outright, but deprioritized. Businesses stop accepting it, okay? Banks stop supplying it. The result is the same without the controversy. The social implications are profound. Financial behavior becomes legible and enforceable. Deviations stand out. Nonconformity attracts friction. For most people, convenience outweighs concern until convenience disappears. By then, habits are entrenched and options are limited. This environment also reshapes incentives. When holding funds outside the system becomes difficult, risk-taking increases inside it. People chase yield to offset inflation, often through complex products they do not fully understand. Institutions profit from this flow. Losses, when they occur, reinforce the narrative that more oversight is required. The cycle tightens. What's striking is how predictable this progression has become. Analysts can map it almost mechanically. Stress emerges. Controls follow. Digital solutions are proposed. Autonomy recedes. Each iteration is presented as novel, as unprecedented response to unprecedented conditions. The language changes. The logic does not. None of this implies an imminent collapse. Systems can persist under strain for long periods. They adapt. They patch. They defer, but persistence should not be mistaken for health. A structure reinforced constantly is one under load. For individuals, the challenge is navigating this landscape without panic or paralysis. Extreme reactions are as unhelpful as complacency. What matters is understanding constraints and acting within them deliberately. Awareness precedes choice. The most dangerous assumption is that tomorrow will resemble yesterday simply because it did yesterday. Systems do not announce turning points. They reveal them retroactively. By the time consensus acknowledges change, adaptation is no longer optional. This is why discussions about access, liquidity, and control cannot be dismissed as fringe or alarmist. They are central to how modern economies function under stress. Ignoring them does not preserve stability. It merely postpones engagement until options narrow. History is instructive here, not because it repeats perfectly, but because it rhymes. The same tensions appear in different forms. Same trade-offs resurface: control versus freedom, stability versus flexibility, collective security versus individual agency. Every generation believes it has solved these dilemmas through better tools and smarter governance. Every generation eventually learns that tools amplify intent, but do not replace it. Systems reflect priorities. When priorities shift toward containment, mechanisms follow. The current moment is defined less by a single rule than by cumulative direction. Each adjustment points toward a future where access is mediated, monitored, and managed continuously. Whether that future feels benign or burdensome depends largely on perspective and position. Those closest to power experience stability. Those at the margins experience constraint. That asymmetry widens quietly until it becomes visible in moments of stress. And it is in those moments that rules, written long before, assert themselves fully. The final layer of this unfolding scenario is both philosophical and practical. Financial systems do not exist solely to move money. They exist to coordinate trust, predictability, and compliance. Once access becomes conditional, trust is recalibrated. People begin to think differently about what they control and what they merely access. Ownership ceases to be a simple legal fact. It becomes conditional on permission and system stability. This is the fundamental shift the new rules codify. You may have money, but having access to it now depends on the infrastructure, the algorithms, and the timing of your actions. From a practical standpoint, the consequences are immediate. Every business operating on tight cash flow faces risk. Its payroll schedules, supplier payments, and service contracts depend on access. Delays are not just inconvenient, they can be existential. Restaurants, small manufacturers, local retailers, they all operate with margins too thin to absorb systemic friction. While large institutions move funds electronically and effortlessly, smaller actors encounter resistance that can ripple across their operations. The resulting pressure concentrates risk at the edges, leaving the system more resilient in aggregate, but less humane in experience. The same applies to individuals. Access to life, essentials, groceries, utilities, rent becomes mediated. Delays in access are felt directly, not abstractly. A 30-day freeze is not theoretical. It is operational. It disrupts normal life. The rationale of systemic stability remains, but the human cost is tangible. Those who understand this dynamic act preemptively, diversifying liquidity, establishing reserves, or holding assets outside centralized control. Those who wait often react too late. Central bank digital currencies accelerate this dynamic. Programmable money, once normalized, allows restrictions to be embedded in code rather than policy memos. Spending can be limited by category, location, or timing. Incentives can be structured automatically. Compliance becomes frictionless. Enforcement continuous. When digital accounts replace physical cash, friction is reduced for institutions, but increased for users. The cost of autonomy rises. What history teaches is that this is not unprecedented. Greece, Cyprus, Lebanon, experiential experienced incremental erosion of financial freedom under different political and economic conditions. In every case, the pattern was consistent. Reassurance first, restriction second, freeze third, and in some cases, confiscation disguised as stabilization. Systems consolidate control under the pretext of safety. Individual autonomy diminishes gradually, almost imperceptibly, until it is normalized. The current environment reflects the same trajectory, now enhanced by technology and global coordination. Algorithms enforce limits faster than humans can intervene. Digital monitoring expands scope. International alignment synchronizes measures across borders. What once took months now unfolds in days. Timing is engineered to minimize resistance and maximize compliance. Friday evening implementations, weekend inaction, and Monday morning defaults are not accidental, they are procedural advantage. For those observing, the lesson is clear. Preparation requires foresight, not reaction. Diversifying across accounts, assets, and community relationships is not optional. It is strategic. Recognizing the structural incentives embedded in new regulations allows informed action rather than passive exposure. Wealth is not merely what is recorded on a ledger, it's what can be accessed when rules tighten and systems test flexibility. True security lies in redundancy, multiple access points, multiple asset classes, and multiple social networks capable of mutual support. The pattern that never lies restriction, freeze, eventual consolidation, offers guidance. By acting while others wait, one positions for resilience. By understanding the trajectory, one can move from passive dependence to active agency. Every historical collapse reinforces this principle. Systems may appear stable, but restrictions are often precursors to stress revealed elsewhere. Awareness and proactive adaptation are the only defenses. Ultimately, this moment is not merely financial, it is structural. Rules, algorithms, and access protocols define the boundaries of action. Those boundaries are shifting quietly, globally, and rapidly. Awareness, preparation, and strategic movement define survival, not compliance alone. The people who thrive are those who internalize the patterns before enforcement arrives, who act before the freeze, who diversify before restriction becomes the norm. Timing is everything. This is why Friday evening matters, why algorithms matter, and why coordination matters. Systems evolve in ways designed to preserve stability for institutions, but at the expense of friction for individuals. Recognizing the shift, understanding the leverage points, and acting decisively transforms vulnerability into opportunity. Those who grasp these principles do not merely survive, they retain agency when permission is removed, when access is mediated, and when systems impose limits. The informed act, the prepared position, the independent move. History confirms it. Today is no different. Wealth inside the system is conditional. Wealth outside the system is freedom. The difference is measured by the ability to act when every hour counts. The rule is now live. Restrictions are in effect. The weekend provides no pause. Monday morning will separate those who prepared from those who waited too long. Decisions remain personal for now, but the window is narrowing. Executive power lies with unelected banking authorities. One decision could render ATMs inaccessible. One declaration could freeze accounts nationwide. The legal framework for total control exists today. A $500 limit is only the beginning. Tomorrow, access could be fully curtailed. The timing is not arbitrary. The derivatives market creates invisible pressure that institutions cannot ignore. Global exposure exceeds $1 quadrillion. A quadrillion. Instruments, layered upon instruments, bets built on bets, all creating a fragile illusion of value. When a major position fails, the cascade is unavoidable. Defaults trigger margin calls. Margin calls trigger forced sales. Forced sales trigger collapse. The interconnected system does not pause for weekends. Any large failure could spread contagion before markets even open. Withdrawal limits are not about safety, they are about containment, ensuring the public cannot exit before instability propagates. Meanwhile, central banks continue to hedge. Gold accumulation has surged. China added hundreds of tons in the last 2 years. Russia continues stockpiling despite global sanctions. Even the Federal Reserve's holdings show similar trends. This is not contradiction, it is admission. They know what survives systemic stress. They know what retains value when confidence evaporates. Gold does not require permission. Gold cannot be frozen. Gold exists outside the digital perimeter. And while the public is nudged toward digital systems, and access to alternatives is restricted, the infrastructure to enforce control is quietly expanding. The sequence is unmistakable. Denial is ending. Restrictions are beginning. Anyone who studies historical crises knows the pattern. Freeze follows restriction. Confiscation follows freeze. Collapse follows systemic stress. Timing is the only variable. Preparation is the only advantage. Because once the freeze is fully implemented, the sequence will proceed regardless. The informed act before others, the prepared position before panic sets in, and the independent preserve their freedom while the system enforces compliance.